Imagine you're trying to understand where Gen Z really lives in its free time. Not at airports or in hotel lobbies, but on phones, on screens, and inside the worlds of games, anime, music, and online creators. That whole space is what we call Gen Z digital lifestyle and fandom. On this first slide, I want you to see where Gen Z digital lifestyle in fandom fits inside the broader travel, leisure, and hospitality sector. Instead of selling flights or hotel rooms, this block sells something more invisible but very powerful: attention, identity, and a sense of belonging. It lives on your phone, on your screen, and in the fan's head. Inside this block, there are 4 big buckets. First, gaming and interactive worlds, online and mobile games, virtual worlds, and platforms where people play, hang out, and even build their own games and content. Second, streaming and digital media aimed at younger audiences, anime, youth-focused video platforms, music and fandom-heavy streaming services. Third, toys, games, collectibles, and licensed merchandise built around intellectual property, character toys, trading cards, fashion collaborations, and digital items like skins and emotes. And fourth, creator and fandom platforms, the tools that allow individual creators, streamers, and influencers to build communities and monetize fans directly through subscriptions, tips, sponsorships, and digital goods. All of this sits in the same wallet as traditional travel and leisure. It's not an add-on. It directly competes with physical trips and nights out for the same share of wallet and the same share of time. On this slide, look at the 2 bars charts that show how big and fast-growing the core fandom markets already are. On the video games chart from Precedence Research, you can see the market at around 2024, sitting close to the $180 to $190 billion range. The graph shows it climbing year after year, moving from roughly $270 plus billion in 2024 towards more than $700 billion by 2034. Behind that, there are about 3.4 billion players worldwide and around 1.5 billion paying gamers. This gives you a sense of the scale. Almost half the planet plays games, and a large slice of them are spending money inside those worlds. Now look at the anime market chart. In 2024, the bar is just above $80 billion, around $80 to $82 billion. As you move across the graph to 2034, you can see it more than doubling to over $200 billion, which works out to roughly 9 to 10% annual growth. Anime is one of the purest examples of IP that travels everywhere, across streaming, games, toys, clothing, and live events. The key message from these 2 charts is simple. Games and anime are already huge businesses today, and, if these forecasts are even roughly right, they could be far larger 10 years from now. In this slide, we move from the content itself to the money that spins off around it: merchandise and the creator economy. Licensed entertainment and character merchandise, everything from character toys and trading cards to fashion collaborations and collectibles, generated roughly $160 to $170 billion of sales in 2024, according to Intel Market Research. That market has been growing at about 6 to 7% per year and is projected to approach $270 billion by 2031. This matters because it shows how far a strong character or franchise can travel outside the screen and into the physical world. Now focus on the purple bars in the global creator economy chart. In 2024, the Market.US data shows the creator economy at around $150 to $200 billion. From there, the bars step up sharply year by year, with the forecast crossing $1 trillion by 2034, which implies growth of about 21 to 22% per year through the decade. This is exactly what our written analysis described: a creator economy of roughly $200 to $205 billion in 2024, expected to grow 20% plus annually, and potentially pass $1 trillion in the 2030s. Together, these numbers tell you that fandom is not just about watching content. It is a full economic stack of IP, merch, and creator monetization that could be several $100 billion bigger within a decade. Billion social media users. That is most of the connected world. The GWI data reportal charts show that, quarter after quarter from 2021 to 2023, people have been spending about 2 hours 20 to 2 hours 30 minutes per day on social media alone. In the age and gender chart for January 2024, you can see younger groups at the top end. women aged 16 to 24 spending about 2 hours 59 minutes per day, with men in that age group at around 2 hours 32 minutes. Even the older groups are still spending over 1.5 hours a day. The Pew Research Teens, Social Media and Technology 2024 graphic adds another layer. It shows that roughly 3/4 of U.S. teens visit YouTube every day, and about 6 in 10 do the same with TikTok. Overall, about 96% of teens use the internet daily, and nearly half say they are online almost constantly. Combine that with DemandSage estimates that Gen Z spends around 9 hours per day on screens, including over 7 hours per day watching video content, and you get the key point. The raw attention pool for this block is massive and very concentrated in younger age groups. On this slide, we translate attention into behavior. WARC data indicates that for Gen Z, gaming is now the single biggest leisure activity, taking roughly 25% of their free time, ahead of both social media and streaming video. The Newzoo platform chart helps explain why. You can see that mobile games make up more than half of global gaming revenue in recent years, with mobile holding around 53 to 55% share, while console and PC share the rest. That ties in with survey data showing that over 80% of Gen Z play games on their phones. When your main device is always in your pocket, gaming becomes something you can do in micro moments throughout the day. For investors, this matters because this block monetizes not just time, but emotion, identity, and community. Players and viewers spend money on skins, battle passes, subscriptions, limited drop merch, and digital goods, because these purchases say something about who they are and which communities they belong to. In other words, the business is selling belonging in a digital tribe, not just pixels on a screen. Now let's place this block inside the travel, leisure, and hospitality value chain and connect it to real-world companies. Gen Z digital lifestyle and fandom is a downstream, consumer-facing block. It is the last step where people actually spend their leisure time playing, watching, chatting, and collecting. In contrast, travel platforms and membership models focus on planning and booking a trip. Our block is about everyday entertainment, often at home, that can be used for a few minutes or a few hours at a time. Despite being digital, it has strong links to the physical world. Travel and hospitality brands advertise inside games, on streaming platforms, and through influencers to reach young travelers. Fandom also drives physical travel, as fans fly to concerts, conventions, theme parks, and esports events linked to the IP they love. Sports and fitness intersect through sports leagues, athlete influencers, and live-streamed workouts. To make it concrete, the block includes companies like Roblox, an NYSE-listed user-generated gaming platform, Sea Limited's Garena, which runs hit games like Free Fire, NetEase and Bilibili, key Chinese gaming and anime-focused platforms, IP machines like Bandai Namco and Capcom, merch players Hasbro and Funko, K-pop leader HYBE, and music streaming platform Spotify. These names are examples only, not stock recommendations, but they show how broad this digital fandom ecosystem already is. This slide walks through how these companies actually make money and where their capital is tied up. A big share of revenue comes from free-to-play games with in-app purchases. The games are free to download and play, but monetization happens through small payments for skins, battle passes, and power-ups. Often, less than 10 to 20% of users account for most of the spending, but because there are billions of players, the totals are huge. Another engine is subscription streaming. For video, anime, audio, and sometimes live streams, users pay a monthly fee for unlimited access to large content libraries. Profitability depends heavily on churn, on content costs, and on the platform's ability to raise prices without losing too many subscribers. On top of that, we have ad-supported platforms, where users watch for free but see ads. Revenue scales with hours watched, ad load, and CPMs. IP owners earn from licensing and merchandise, tapping into that $167 billion character merch market in 2024, while creator tools and fan memberships allow individual creators to turn their communities into real businesses within a $200+ billion creator economy. Across all these models, capital is concentrated in intangible IP, software and platforms, content production, and brand and marketing. Digital content and virtual goods have very high gross margins once built, so the core economic challenge is not production cost, but capturing and holding attention at scale. Here we look at how this block behaves when the economy changes and how fans react. In macro terms, this is a discretionary block, but it is often more resilient than big-ticket travel or luxury goods. A $5 battle pass or $10 monthly subscription is much easier to keep during a downturn than a $2,000 holiday. When youth unemployment rises or real incomes fall, fans typically downtrade. They cancel some premium services and buy fewer big collectibles, but they keep cheap gaming, ad-supported streaming, and free social and video platforms. Higher interest rates still matter. Most of these businesses are asset-light, but when capital becomes more expensive, investors become less tolerant of growth-at-any-cost models that burn cash without clear unit economics. The hurdle rate for big content bets and acquisitions goes up. Because games and streaming platforms earn in many currencies, foreign exchange moves can also impact reported revenue, especially when revenues are translated into a strong US dollar. And because many platforms rely on advertising, they feel the impact when ad budgets are cut and CPMs soften. Behaviorally, these products are sticky. A new Zoo/WARC style view suggests Gen Z now spends more leisure time gaming than on any other activity, including social media and streaming. People may switch games or platforms, but they rarely abandon the habit entirely. Fans are loyal to IP and creators rather than to specific platforms, and when a favorite creator or franchise moves, the audience often follows. Promotions and free months drive constant churn and re-sign-ups, but they do not remove the underlying demand for digital entertainment. This slide summarizes the major shifts of the last few years. First, we move from a world dominated by big studios and broadcasters to a full creator economy. The creator economy was roughly $200 plus billion in 2024, and the purple bars in the creator economy chart show it potentially 5 to 6xing by the early 2030s on more than 20% annual growth. That has shifted power away from traditional broadcasters and towards platforms plus creators, who now negotiate revenue shares and sponsorship deals directly. Second, screen time has exploded. By 2024, 96% of teens were online daily and nearly half were almost constantly connected. Live streaming viewership reached around 32.5 billion hours in 2024, up 12% versus 2023 and about double 2019 levels. Esports and game streaming moved from niche to mainstream, and big live events now combine creators, sports, and interactive chat. Third, after a flat or slightly down post-COVID period, the global games market re-accelerated. The video games market size chart shows revenue back on a growth path towards that $700 plus billion 2034 forecast, with 3.42 billion players and 1.5 billion paying gamers in 2024. Anime followed a similar pattern. The anime market almost doubled versus early 2010s levels and is on track for 9 to 10% annual growth to 2034. All of this has shifted power and profitability towards platforms that control discovery algorithms, IP owners with franchises that work across games, shows, concerts, and merch, and top creators and communities. Traditional media and small, physical-only merch players have lost relative power unless they have adapted to digital fandom and direct-to-fan relationships. Finally, we look ahead and think in scenarios. In the near term, over the next 1 to 2 years, the habits we have discussed are unlikely to change. Gen Z will keep spending a large share of free time on gaming, streaming, and social video. And the basic mix of free-to-play, subscriptions, ads, merch, and creator monetization should remain intact. What will likely shrink are the unprofitable growth-at-any-cost platforms, which will have to cut subsidies and focus more on unit economics. We should also see more hybrid monetization, more creator tools and analytics products, and more crossovers between physical and digital fandom, such as live events and limited drop merch. Over the medium term, 3 to 5 years, the block is expected to remain a structural grower, outpacing global GDP. Forecasts suggest video games growing towards $700 plus billion by 2034, anime crossing $200 billion, licensed character merchandise approaching $270 billion by 2031, and the creator economy reaching $1 plus trillion by the early 2030s. At the same time, we may see more pressure on purely ad-dependent low-engagement platforms and flat streaming services with no strong IP or community hooks. In the longer term, 7 to 10 years, some things are likely to be stable. Humans will still want stories, characters, music, and communities, and fandom will remain a core part of youth identity. What could fade are linear TV and other one-way formats that feel passive to Gen Z and general alpha. What could grow are immersive blended experiences, virtual concerts and hybrid sports events co-hosted with creators, and persistent digital identities and assets, such as avatars and skins that travel across worlds. At the same time, we should expect tighter regulation on underage screen time, gambling-like mechanics such as loot boxes, and data privacy and algorithms. Putting all this together, the upside scenario is one where screen time and digital spend keep rising, regulation focuses on transparency and safety rather than bans, and a handful of super platform plus IP universes earn very high returns on capital. The base case is steady growth ahead of the global economy, with strong competition and a mix of winners and losers. The downside scenario is driven by social backlash, strict youth regulations, stagnant ad markets, and AI-driven commoditization, which would slow growth, compress margins, and force smaller or leveraged players to consolidate or exit, leaving only a few large, well-regulated platforms standing.